Have you ever wondered how a private company goes public? How do they transition from being privately held to being listed on a stock exchange with shares available for anyone to buy? The answer lies in a process known as an initial public offering, or IPO for short. Picture a company. It's been growing steadily, building its brand, and now it's ready to take a big step forward. It wants to expand, to break into new markets, to hire more staff. To do all of this, it needs capital, and one of the best ways to raise that capital is to go public. So, what exactly is an IPO? An initial public offering is when a private company offers shares of its stock to the public for the first time. This is a significant milestone for any company as it transitions from being privately held to publicly traded. To start this process, the company first needs to hire an investment bank. The bank acts as an underwriter, working with the company to determine the type of securities to be issued, the best price for the securities, the number of shares to be issued, and the time to bring it to market. Once the underwriting process is complete, the company files a prospectus with the Securities and Exchange Commission. This document provides detailed financial information about the company to potential investors. After the SEC reviews and approves the prospectus, the company can finally start selling shares to the public. The shares are initially bought by institutional investors and high net worth individuals. Then they become available to all investors on the open market. But why would a company want to go public? There are several reasons. First, an IPO can generate a significant amount of capital, allowing the company to fund its growth and expansion. Second, being publicly traded can increase a company's visibility and credibility. Finally, an IPO can provide a company's early investors and employees with the opportunity to cash in their shares. However, it's important to remember that investing in IPOs isn't without risks. There's no guarantee that the company's shares will rise in value, and they can be highly volatile, especially in the short term. To recap, an IPO is a process that allows a private company to go public. It involves hiring an investment bank, filing a prospectus with the SEC, and finally selling shares to the public. It's a significant milestone for any company, but it's also a risky investment that requires careful consideration. So the next time you hear about a company going public, you'll know exactly what that means. It's not just a headline, it's a complex process that transforms a private company into a publicly traded one. It's the world of IPOs where private growth meets public capital.